Hello, welcome to Crux Investor. We caught up earlier today with Murray Nye. He's the CEO of TSXV listed Winston Gold, and he talks to us about their plans for a fast track strategy. And if you want our thoughts on that, the conversation, the company itself, you can get that at cruxinvestor.com/club, where you can also find detailed company reports. You can get commentary from experts from around the world on a variety of companies and commodities. There are training videos on there to help you do analysis. There is summaries of other interviews to save you a little bit of time. And of course, there's a big thriving community of investors sharing their thoughts and ideas with each other in a nice, safe environment. So do go and join them at cruxinvestor.com/club. Of course, we'd love your feedback too. So do give us a like, leave your comments below. And if you want to see what we talked about today, take a look at the description. Murray, how are you doing, sir?
Very good, Matt. Nice to see you this morning. I guess it's afternoon where you are.
It is. Mid-afternoon. Long way to go. Yep. Okay, and are you well? How is life in Winnipeg?
Winnipeg's good. We've had a little outbreak in COVID in the last 2-3 weeks, and they've gone into what they call a red zone, which means you can't really do any shopping in stores, only for necessary items like food and but nothing other than that. You can only get very few things. The stores are quite barren actually.
Yeah, we had the great toilet roll run.
Right.
That's an unfortunate turn of phrase.
I remember that.
Yeah. I think we've learned our lessons. We're coming out of lockdown, and I think we're going to do things differently this time. So, well, look, Murray, first time we've met, first time we've spoken. Looking forward to hearing this story. We've heard a few similar stories about people trying to take advantage of the current precious metal market. So, looking forward to hearing yours. But first of all, kick us off with a 1-minute overview for people new to this story, if you don't mind.
Okay, well, what we've been focused on, Matt, is high grade opportunities, and we had a similar situation we put into production back in 2010, a high grade gold mine near Helena, Montana. We came back in 2014, acquired this property, and it showed some very good historical high grade zones on the property. So we thought we'd give this a try because we were looking for that kind of an opportunity. So we keep our costs as low as possible. Right.
Okay. Thanks for that. Can we go back a bit though, because this company seemed to be a big deal back in 2016, beginning of 17, and then it's kind of died off and flattened a bit. So what was happening back then?
Well, we just took the company public in March of 2016 in a very, very tough market. In fact, it was a $550,000 underwriting, Canadian. And the CFO had to write a check for $50,000 to get it finished. That's how tough the market was. We were doing it with Mackey Research in Vancouver. Subsequent to that was in March. In September of that year, a group out of Vancouver had some really good success in the lithium market with a deal called the Lithium X. Some of the principals behind that company had a high-grade gold property located in Arizona, and they were shareholders of ours in the previous deal we did in Montana, the Drumlummen mine, in a company called RX Exploration. So they liked our operational skills, and they said to us, "Would you come and consider our property?" So what we did was we took on their property on an equal basis, where they received just about as many shares as we had in our company. But they had some very good connections as far as financing at that time, because they had a very hot hand in the market. And when people understood that they were involved, they were able to bring in some financing for us. And we had 2 private placements that we did in December and early January that brought in over $5 million. And we started to drill, and because of that excitement, the stock kind of took off, and then the market got tough again in latter of 2016, and the gold stocks were not very favorable, and very, very tough market. And the stock kind of drifted down into I'm going to call it the 4 or 5 cent range.
Yeah, I mean, we can sort of see it. And is that the same asset that you were going to be talking about today?
Yes, exactly the same asset.
Right.
We had some very good drill results on it, Matt. It looked very exciting, but then it became very, very tough to raise money and do some more exploration. But we were able to kind of turn that around at the end of 2017 and start drilling again.
Right. So how much money did you spend back then? I mean, there's obviously
some spent about, I would say we spent about 5 million Canadian
in the ground.
in the ground. Yes.
Right. Okay. So you've got a bit of historical data. You've got some of your own data. Yeah. Okay, that's interesting. Okay. Well, like, why don't we kind of kick off with the kind of the business? Trying to, if you don't mind, explain what the business model. You've got a few nice names associated with this in terms of people on the board, like Joseph Carrabba, for instance, ex Newmont. So you've got the right people associated with this now. You've said it very clearly in your deck and any of your communication. You're trying to take advantage of the current precious metals market. So let's talk about what you're setting out to do. So what's the business plan?
So there was 640 historic drill holes on the property, and there was a really nice looking vein. It was running parallel to the Custer vein, which is the major producer on the property. And we called it parallel vein, and there was 3 drill holes into it, and they showed very, very high grade. If you don't mind, I can talk in ounces, or would you prefer grams, or does it matter?
We're all good.
Anyways, there was 3 really good drill holes showing a strike length of about 300 feet. The grades were in the half ounce range, or if you like, 16, 17 grams. And with pretty good width, showing about 5-6 foot of width. So that was kind of our style was narrow vein, high grade. So we took a look at this, and we'd raised some money. So we set up the drill to try and duplicate that hole. Fortunately, the surveys were right on this particular part of the property. Some of the surveys were off, and we couldn't duplicate some of the very high grade hits that they had historically. There were 640 drill holes into that, by the way. I mentioned that earlier. But on the way down, we hit another vein called Block 93, and we named it because it was near some old workings, and they were called Block 93. So we hit that vein on the way down first, and then we did hit parallel right where we thought it would be. And Block 93 was about 3.5 feet wide, or roughly a meter, running about a third of an ounce, 0.3. or 10 grams, and parallel was 4.5 feet wide, and it was running almost half ounce in that particular drill hole. So we set up and just drilled those off over the course of the next year to try and establish some sort of continuity to those 2 veins. And we did that. And with that in mind, we thought at the time that what was really important to me was we had a very good operation over in northeast of Helena called the Drumlummen Gold Mine. We put that into production in 2010, and we had a very, very good crew on that project. Geologists, miners, mine superintendents, and just a real good group that I wanted to try and capture again for this project. And some of these guys were going other places. So we had enough continuity with the drilling that we decided to drive a drift in, or a tunnel, if you like. And roughly between those 2 veins, roughly 900 feet. And that would give us access to both of those veins to start call it a bulk sample test mining program. So we thought that was a strategy. Number one, we thought we could get to cash flow faster. One of the best mining guys I've ever met in my life was a gentleman by the name of Mike Gunsinger. And one of the things he told me when I first started this back in 2005, Matt, in that state, where Mike introduced me to the state, he said, Murray, always remember this. You drill for structure and you mine for gold. Don't ever forget that. And he looked me right in the eyes when he said that. And I could tell what he meant. He says, you can drill forever, but it's at some point you got to figure out what you're doing. And the best data you're ever going to get is by drifting on the veins. So what we did was we decided to get on those veins as quick as we could for a few reasons. One, we'd get better data. B, we'd capture the people we wanted to capture. And that was critical to being successful in this. So that was my feeling. And then, so as a result of that, that's why we proceeded with what we call a fast track strategy.
Okay, well, talk to me about this fast track strategy, because again, it's something. I mean, we've kind of jumped both feet into the project per se. So if I sort of step back a bit, this fast track strategy mentality is what people need to be comfortable buying into in terms of your approach, because convention says you go through, you do your drilling, you do your studies, you work out the economics, you kind of make it, de-risk it, et cetera, et cetera. You're saying no, it's historic workings. We've got a lot of holes in here. We've got a lot of data, certainly enough to get going, and your advice was, you can drill for data, but you mine for gold. That's
Right.
the mentality. So
That's the mentality. Yeah.
right. Okay. So, and given the, I mean, it's come off in the last couple of months, the price of gold, but your view is going forward, it will continue to remain at current levels or better, right? You've got to believe
Right.
that. So,
Right.
talk me through, why is a fast track strategy good? Why shouldn't people go and listen to other stories which have a more conventional approach?
Well, I think they're both good. I'm not gonna discount the other method, drilling and getting a pre-feasibility study done and all that sort of stuff. But that takes a lot of money to get that put together. I was more concerned, or we were more concerned about getting the right people involved. And if we didn't start soon, those people were going to be drifting off to other projects. And I felt that it was very necessary for us to get the right people to run this project for us. It's not as if we didn't have a lot of data. We had, from the drilling we did and the historic drilling, on those two veins, we had roughly about 1,200 feet of strike length. The Block 93 vein was 3 feet wide on average, and parallel was roughly 4 feet wide on average. So we had some structure there of over 1,200 feet. The widths I've just described to you, and the vertical extent of both of those veins was roughly 300 feet from the drilling we did. So we thought we had enough of a resource there to get started with. And then also, what happens when you get underground, you're able to set up underground drill stations, and they're going to give you a lot better data than, say, surface drill stations, because for one thing, permitting a surface drill, it takes over a month. In Montana is one of the best jurisdictions anywhere for permitting this stuff. In Canada, it might take you 6 months to get a drill station permitted. So we had underground drill stations, which are a lot closer to the material we're trying to hit. We've got the infrastructure in place. We're drifting on the veins. We're getting, as good a data as you would from the drill. And while we're doing that, we're making some muck that we're stockpiling that we're going to put through a mill that we've leased for the next 3 years.
Okay, I'll talk about the mill in a second. But if I look at this, I need to understand, or I need to believe that you understand the costs around this. Okay, underground mining more expensive than open pit, all the kind of obvious stuff. How do you work out what this is going to cost you, and therefore what your margin is going to be? If there's going to be a margin.
Well, we've got an all-in sustaining cost estimated at roughly around $850.
How do you work that out? How do you know that?
Well, we worked it out from the experience from the other mines that we put into production. We had a lot of experience from the Drumlummen mine. We knew exactly what our costs were. We know what equipment we need, how to acquire that equipment at a reasonable cost. How to get very good miners. I mean, if you're dealing with narrow vein underground, you've got to have very good people working for you, and you bonus those miners to stay on the vein so that they don't drill into the waste. Now, one of the things we put in place that I don't think very few, if any, other junior mining companies have is their own assay lab. And the reason for that is we want good turnaround on our drilling, and we want good turnaround on our mining. So what we need to do is we need to have those drill results right away and have it assayed. Right now, the backlog on drilling is 6 to 8 weeks. So you could be drilling and not even know what you're hitting. You're hitting a vein, you might not even know if the vein's carrying anything. So we get turnarounds on those drill results from our assay lab in roughly 12 hours. We also send those assays out for check assays on a regular basis, and our assayer is very accurate, and our assays are bang on as far as any check assays we've done. On the other side of that, when we drill and blast a face, the geologist goes in and samples that face. So when he comes back out, he puts that into the assay lab. The assays that. So we've got channel samples along that face and chip samples. Then he comes back and marks that face up so that we're not drilling and blasting into waste. So we're trying at every opportunity to maintain grade control. That's also important to know what you're shipping to the mill. So when we do take a round and drill and blast it and put it on the muck pile outside, we then sample that muck pile so we know what we're shipping to the mill, so that we can get a constant what we hope to do is get a constant grade going to that mill, so that we can we have a consistent mill grade going to that mill, so the mill is tuned up for that type of material.
Okay, well, let's come on to the mill. Okay, Paradigm, you pick that up. I think it's plated for 150 tons a day. You're going to spend a little bit of money on it. I mean, when does that thing get up and running?
It's going to get up and running today, hopefully. We had to we've been talking about putting a crushing circuit, getting it ready. The crushing circuit was wired last week. We tested it on Friday. It crushed, in 2 hours, it crushed 200 tons. So we're very happy with how it turned out. Filled up the hopper in a couple hours. And then we ran the ball mill for about 4 or 5 hours on Saturday, just to see what kind of deficiencies it had. We had to do a few little tune-ups. One of the oilers or lubrication systems on the ball mill had to be redone. Some of the hoses and fittings were corroded, so we were working on that yesterday. We have a Nelson concentrator in the ball mill, and it takes a lot of water. The well wouldn't keep up with it, so we ran a return pump from one of the tailings ponds back to the Nelson concentrator to get it running. So, I think we're way ahead of the game, because, we've got this ball mill, or this gravity flotation mill, I should say, and we've leased it for $20,000 a month, and we pay the owners $12 a ton to mill there. Something like that would take anywhere from $5 to $10 million. Plus, you'd be waiting 3 to 4 years, if not longer. So, getting back to that fast track strategy, this opportunity was available. And then, of course, you're going to lease a ball mill, you better have something to put through it. So, we thought we were far enough along with our drilling to put that tunnel in, which we named the Carrabba tunnel, and get on these veins, get some very good data from drifting on them, and then have that stockpile go into that mill, so we could start that mill up with some, call it lower grade to start with. We don't want to put any high grade through there, but we have material stockpiled, roughly 4,000 tons sitting there, and we're ready to go.
Okay, and what's the cutoff on that?
The cutoff grade?
Yeah,
I would say our cutoff grade is a 0.1.
0.1. Okay, really. Okay, pretty low stuff compared to the.
It's 180. At 0.1, it's $180. $180 rock. So.
Okay, so that's just
a little bit.
You're going to make a little bit of money, get the ball rolling, but you're chasing high grade. So at some point you'll reconfigure. So again, tell me about the terms that you've leased it, and you are incurring the cost of getting it up and running again.
Yeah. They spent $4 million on it, Matt. They relined the ball mill. They put new charge of balls in it. They put the Nelson concentrator in it. They hired a very good metallurgist out of I think it was Butte, Montana. He came in and did a lot of work for them, getting it tuned up. So they spent $4 million before we got there. And what we had to do was put the crushing circuit in, and we spent, I would say, roughly $500,000 getting it ready out of our deal. But we have pretty much a brand new mill. I mean, the tailings pond was brand new. There was nothing in it except a little runoff water. So we had a brand new tailings pond. We've got room for 3 others at that mill site. So I think we're in good shape in acquiring that. Yeah. And we've got it for 3 years on a lease basis with an option to purchase it in the 4th year.
Have you set that number, the purchase
number?
Yeah,
$4 million. Yeah.
Okay.
We have an option to purchase.
Interesting. And is it fully permitted?
Yes.
Okay.
Yeah.
So that's happening. So let's get back to the mine and try and work out when you're going to be able to feed the high grade stuff there, because I guess high grade people get excited about. So what does that look like?
Sure. Well, we put the Carrabba tunnel in, and the next phase of that is what's known as sill drifting. And if for lack of a better description, it's a tunnel, and that sill drift goes along the entire length of the vein. Okay, so we've got a sill drift on what we call Custer West right now, running over 200 feet. And we've got a sill drift running on Parallel East, running for over 100 feet right now. So what those sill drifts are doing are setting up what the next phase of this project is called a shrink stope. That's the method we're going to use to mine this, Matt, by the way. It's a shrink stope method, which is very, very accurate. It's not done too often nowadays because it does take a lot of talent. So you have to have an experienced crew in there. So what you do once you have the sill drift done, you leave a pillar. When I say a pillar, you leave about 10 feet or 15 feet on the roof, if you like. Then you go laterally for about 30 or 40 feet. And then you come back at roughly a 60-degree angle in what they call a bean hole raise, which gives you access to the vein that you've just mined along the sill drift. And then what you do then is you just mine the vein. You don't mine that 10 foot wide. The sill drift, by the way, is 10 by 10. So then you just mine the entire width of the vein, whatever it is, by about 10 feet high.
Okay, so this is small scale mining model. This is the small scale mining model, right? Okay, so there's a few words in there which again help people understand if it's something they want to get involved with, which is
Sure.
the small scale component to it is there's no kind of blue sky to this. I mean, how do you go about expanding out what the known the known mineralization?
Okay, well, we're on one level right now. All right. So then the plan would be the best description we're going to be using a ramp method to get lower. So to get 100 feet lower, you have to drive what's about a 700 foot ramp. Okay. So 100 feet equals 700 feet. So once we get lower, we can start another level at that elevation. So then you've got a level at, say, 300 feet, then you go 100 feet lower. So that's your 400 level. And if you've been paying attention to our drill results, we've hit two very, very good holes, roughly 40 feet below us and 80 feet below us. I just, off the top of my head, I might be a little inaccurate here, but the first hole was roughly, I'll say where we're at right now on parallel west. The first hole was roughly 30 or 40 feet below us and about 40 or 50 feet ahead of us from where we are now. And that intercepted a 5-foot zone running over 1 ounce per ton. Then we have another drill hole roughly 300 feet from there going further. And it's roughly 80 feet below where we're at right now. And it was 3 feet of 0.6 ounces per ton. So you can infer, we got more drilling to do there to infill that, but right now it looks like we got a 300-foot strike length on that of some very, very good ore, roughly 100 feet below us. So once we start that elevation, so just to give you a little bit of background on that, Matt. By the way, it's low tonnage, but if you got one miner working in a shrink stope, that miner at a 4-foot wide vein can roughly create 30 tons per heading per shift. So if you intersect that vein and you've got 2 headings, that gives you 60 tons. So if you then put another bean hole raise, let's say down about 80 feet from your first one, you can start 2 more headings there. That'll give you another 60 tons per shift. So with that in mind, with 4 headings, you can create 120 tons. And if you get 2 shifts, you can create more muck as a result of that. Okay. So it is small scale, but we're more focused on ounces rather than tons. We're trying to mine ounces, not tons. So
no, I understand that.
And of course, that keeps our costs lower.
I understand that. But what's the point? Because you talked about $850 number there. When do you get to the point when you can confirm that is the case? Because in terms of recovery rates, dilution, metallurgy, all of that usual high risk stuff that in high grade mining, how much data or how much more time will you need to be able to get a handle on those numbers?
Well, I think over the next 2 months, Matt, because we're, like I just indicated, we are starting the production stope on Custer West. So we've got that stope it looks like it's going to be about 200 feet long. The vertical on it looks to be about 150 feet high, maybe higher. There's some other historic drill holes that are a little higher, but 150 feet high. And we estimate the vein by the sill drifting we've done. And it's very good data that we have. We estimate the vein being roughly 4 to 5 feet wide for that entire length. So that once we get on that vein, we start mucking that out. We ship that to the mill. We're going to have a very good idea what our costs are going to be as we advance that cylinder, or pardon me, that stope.
Okay, and what does the price need to look like before this gets a little bit tight again? Like you experienced back in 2016, 17, the markets went away for you. How much headroom have you got?
Well, we've done all our financial modeling at $1,200 an ounce gold, 11 to 1,200. So we think, when we started this project, when we decided to put the Carrabba tunnel in, that's the numbers we were working with. So we thought we had some, pretty good margins at that price. But now with gold being 1,800, of course, it looks that much better for us. So we're quite comfortable with what the kind of margins we can produce, Matt.
Okay, and you've been raising money this year. You've raised what? How much you've raised this year? Do you reckon?
Oh God, I'd have to go back and look, but I think it's about 8 to 10 million. Yes.
Right.
Yeah.
Okay.
Yeah.
And you've done a lot of that in Germany, in Europe. Why is that?
Well, we had some. I got approached by the German mining group, and they had a program for us that we could talk to high net worth investors and institutional fund managers, and it was a reasonable kind of call it bill that they were approaching us with, and I thought, well, yeah, that's a very good idea. We should try and get this story out to the Europeans. They've been very, very successful in helping us with this project. They've brought in an investment, and I've been doing about 2 calls a week with institutional investors or high net worth individuals. The other thing that we've raised a lot of money is in the United States. We've also had the Palisade group, call it from a more institutional line. The Palisade group have invested, I think, $1.5 million or maybe $2 million into the project so far. But then with Joe Carrabba's contacts in the United States, we've had some very good success attracting investors in the U.S. And a lot of these investors have never ever invested in the gold market before. So I think that market in the U.S. is starting to take shape. There were very few investors interested in gold in that country, but now it's a lot of people are getting very, very interested in it. Yeah.
Do you think that works better for you guys? Because, like I said, we talked about, people have been investing in natural resources mining for a while. They understand the conventional process. For you guys, in this environment where people are maybe coming out of the tech space or the Robin Hooders or whatever, they understand the market and the processes less well, and therefore a story like yours may sound absolutely reasonable and fine compared to, let's say, the people who've got a different view.
Yeah, I think so. That a lot of them, we get some very, very interesting questions like, how do you know the gold's there, right? So we have to walk them, call it mining 101. We have to walk them through the fact that we take a diamond drill and we drill it and try and hit a vein, and then and there's a lot of science behind it. It's not hocus pocus. I mean, there's a lot of science behind mining for sure. I mean, and like I said, we have a very good drill. By the way, I didn't mention before, we have our own drill team, and we have 2 of our own drills. So we can drill at probably about half the cost of other companies. So that keeps our costs low. And is that
underground mining drilling you're talking about, right?
We have our own drill crews, and we have 3 of our own drills. We have 2 underground drills and 1 surface drill, and they're pretty much going continuously. So they're drilling out ahead of where we're mining. So we're trying to improve the resource as we drill and keep ahead of ourselves and looking for newer material that we haven't discovered before.
Okay, look, just talking to shareholders and obviously people new to mining and retail miners at that. The management, I know you mentioned that Joe's a big holder. How much does the management team hold?
Yeah, the management team, and call it close friends and business associates, we've done a tally on it. We estimate around 150 million shares is what that group owns. These are very close shareholders of ours that have pretty much invested in every round of financing we've done. So we've been very, very lucky and fortunate in getting this type of shareholder base. And Joe himself has put in, I think, over $3 million into the company of his own money. So, he's been a big supporter and endorser of the company. Now, if you don't mind, Matt, I could talk about that experience of meeting Joe. Got on a call much like you and I are talking today, and he had a series of questions just like you're asking me, and I brought Ben Porterfield on, our head geologist, and Ben's also a director of the company. So Joe had a series of questions, and somebody told me it was kind of a hurry up deal. Said, "Can you get on a call with a New York Stock Exchange listed mining executive, and can you do it in the next 3 hours?" And I said, "Well, possibly. I'll see if Ben's available," and he was, fortunately. So Joe had all these questions, and we were very experienced. We've got a lot of experience in the mining side of things, so I was impressed by his questions that he was asking. We answered his questions. At the end of the call, he said, "Guys, you've answered my questions to my satisfaction." Like I told him we had our own assay lab. I told him we had our own drill crew and our own drill and stuff like that. And that, it was on patented ground. And so Joe being on the board of Newmont for 10 years, he was also under sustainability and risk committee and also on the safety committee. So he chaired the sustainability committee. So he's very familiar with the projects and the risks associated with them. And so his risk assessment of it was starting to intrigue him. So I asked him at the end of the call, and I've done this a lot, Matt. Very few people take me up on this offer. I said, "Would you like to do a site visit, Joe?" And fortunately, it was in the end of the summertime, so the weather was still nice. And he said, "I'll think about that, Murray. I'll get back to you." So and everybody gives you that kind of line, but I said, "Okay, well." So he emailed me the next day. He says, "I can be there next Tuesday. Does that work for you?" I said, "I'll make it work." So we happened, fortuitously, we met, he was coming from North Carolina. I was coming from Winnipeg. We met in Minneapolis. So we flew directly, sitting across from one another. Our seating was even good that way. We're sitting right across from one another. So we chatted all the way down. So we saw the property, he saw the drill core, he saw all the infrastructure that was in place. And when you talk about infrastructure, I think that's a very important thing to mention. There's a major highway, paved highway within 2-3 miles of the property. And then we're on a very, very good county road. So we're not building roads in the middle of nowhere for 20, 30, 40 miles where miners have to commute into the mine and out of the mine for 2 to 3 hours a day. It's very easily accessible. It's low elevation by Montana standards, so that means that we can mine year round because the snowfall is not that great in that area. The other thing, there's a major power line going right through the middle of the property, so we're very fortunate in that respect that we've got power there. We haven't hooked it up yet because that's a big expense, but we do have the power right to the mine site when we do want to hook it up. Montana, where we're located, is roughly 27 or 37 kilometers outside of the state capital, which has very good schools, hospitals, jet service, and very good accommodation for people to live. It's a very, very nice community. So that's attractive. Montana has a very good workforce. And of course, a lot of these guys want to work at home. So we've been able to attract a lot of talent that way. So when Joe looked at all this, when he does his risk assessment for Newmont, they have a criteria. So he said, "Murray, at the end of the conversation, he says, as far as, when I'm looking at this, he says, you check all the boxes, except you don't have a big resource. But in every other respect, as far as risk factors are concerned, you're in one of the best jurisdictions in the world. Like, you might say Canada, the United States, and Australia are probably the 3 top ones." He says, "You've got infrastructure in place, you've got workforce, you've got good grade." Grade is very, very important because, obviously if you can mine 0.2 or a quarter ounce per ton, you only have to move 4 tons of material to create an ounce of gold, as opposed to your competitor that has to move 10. So you can keep your costs lower because of that fact. So when he looked at all this, we didn't have the big resource, but he could still see the potential there. Because getting back to Mike's comment, Matt, when you say drill for structure, mine for gold, the historic mine on the property, we haven't really tackled it yet because we haven't had the money or we're not in the right position, is the Custer mine. Now, the Custer mine was mined continuously for over 2,400 feet. And back in 1890, it was one of the longest, if not the longest vein in the world. So when you looked at that, it was only mined down to 400 or 500, probably 400 feet, I should say. So we thought there was a big resource potential below where they stopped mining, basically because of the water table. So when he looked at all this, he said, I really like this. And I said, "Would you consider an equity investment?" He said, "Well, I think I'd put $200,000 into it, Murray." But since then, he's been a very big supporter, became the largest shareholder, and then becomes executive chairman. And him and I talk 4 or 5 times a day, Matt. We're very, very intertwined in the business, and he's very, very helpful. He knows a lot of people, and any resources we need, he's got access to.
Fantastic. Well, that's nice to hear the beginnings of that relationship. But tell me this, I'll just finish up on this one, which is, you obviously been raising money, this year. I think it's around $10 million near Stammet. How much of that have you got left, and what's that going to allow you to do? And will you need to raise more capital before you can actually get the mill operating and spewing out gold?
No, I think we've got enough money. We can actually get the mill turning and spewing out some gold. I'm not sure. I'm not going to promise a lot of ounces right now, but we are going to produce some ounces probably before the end of the year. So we are going to offset some of the costs that we've been incurring with the gold production. Keeping in mind that that shrink stope, or the first production stope, is being developed right now. That should come on stream probably in 2 to 3 weeks, and we've got enough muck on the ground that we can run the mill at a test phase just to tune it in, probably at about I'm going to say, Matt, about 80 to 100 tons a day to start with. But we've got some low grade there. Then we've got what I'll call some mid grade. It's roughly a 0.2. And then we've got some higher grade 0.3 to 0.4 ounces per ton sitting there as well that we can test that mill out with. So we are going to produce some ounces.
Fantastic. Well, Murray, appreciate you coming on, telling us that story. With this fast track strategy of yours, you're going to need to keep talking to the market, because it's unconventional, but if you keep delivering, people are going to keep listening. So appreciate your time today.
So far, so good, Matt. Yeah, thanks. Thanks, Matt. Thanks for being on your show.